Welcome everyone. I welcome you especially to Legit Crypto and Forex. And today I will be teaching us something very rare, something that people don't talk about. And I don't want you to skip any part of this video because it's something very rare. People don't talk about this, but it's one aspect of Forex trading that help traders to understand the behavior of institutions, of market makers, of hedge fund and banks. So follow me on this journey from beginning to the end. Don't skip any part of this video. Learn until you have learned so much. Now, in your ability to learn so much, you'll be able to be profitable in your trading. One of the things that makes people to lose out of forex is that they have limited understanding of what they are doing. Now they don't have a mentor. They just enter the market haphazardly and then be on a loss and close the trade or account being blown. So to avoid such kind of pitfalls, you need to understand deeply what we're doing here. Now, I have been trying my best to teach. If there is any kind of question that you're having, please don't hesitate to chat me up on the comment section. Drop your concern on the comment section, and I'll be there, right there, for me to reply your concern quickly. I'll be there. Now, I appreciate our new users, new subscribers, and also our returning subscribers. I actually want to especially appreciate you for finding it fit for you to always check our channel. Don't forget to subscribe. Don't forget to click the notification bell so that you'll be notified whenever I upload a video such as this. I will continue to try my best to see that I disseminate the knowledge that I have acquired and I've been using for the past 9 years in forex trading. Now, thank you so much for those that have been asking of mentorship. Those have been asking me for training, advanced training, masters training on forex. All you have to do is to chat me up on the comment section and I will reply you quickly. Thank you so much if you have done that. And also don't forget to share this video to your family and friends. Now, I'll be teaching on mitigation blocks. Mitigation blocks. And this mitigation blocks is going to help you a lot. So, like I used to do, I'll be using my own material on this topic, mitigation block, and I'll be doing it both with practicals so that you'll be able to understand what we are doing. Okay, sit tight while we move. Now, mitigation block are a specialized concept with the smart money concept. That's the SMC framework. Now, this is actually closely related to other blocks, so you need to watch my previous video on other block for you to fully understand the mitigation blocks. You need to understand the other block. I will try my best to actually do like a few minutes, few seconds revision on other block before we kick start, so that you'll be able to understand this very well. Now, there are differences between order block and also mitigation block. Order block and mitigation block. Now, there is differences in their formation and in their application. They represent price zone. That's the mitigation block. It represents the price zone where institutional traders revisit to mitigate or rebalance on field order. Now, this is often signaling potential reversal or continuation. Now, understanding these mitigation block enhances a trader ability to align with institutional order flow, especially in the context of liquidity dynamism. Now, as we have discussed previously on liquidity. Now, let me move to the basis now. Now, mitigation blocks are areas where price fail to continue a trend. Now, fail to make a new high or a new low. That is what we mean when price fail to make a new high or a new low. Now, due to institutional activities often marking a shift in market sentiment. Now, they are part of the inner cycle traders methodology, which emphasizing following smart money. Now, let's move on. Now, look at it, guys. Look at this particular pair, Euro USD. It's actually a liquid pair, and then I'm using it most times because I love the pair. Actually, a liquid pair. Now, let me get my pen. Look at this particular place. Now, you discover that this was the high here, and then the price had to come back to revisit this particular high. Now, price revisiting it before going down for this sell is actually what we mean by our mitigation block. Why? Because there are contracts, that are trades that need to be filled up before price continues. Now, most times you tend to see these on as what we call the triple top or the triple bottom. I know you have heard of the triple top or the triple bottom. Now, most times you tend to see this on the triple top or the triple bottom, and this can happen on higher time frame, like the 1 hour, 4 hours time frame, and even our 15 minutes time frame. You can see it. That's on our boom and crash. You can also see it on the 15 minutes time frame. Very clear mitigation block whereby price must revisit before it would change direction. Now, if you notice what was happening here, it was a dangling kind of process going up. It was dangling going up, and the fall was actually a clear fall. Why? Because it was supposed to fall. Just that the institution had to take back the price up and then revisit this particular place. Revisit this particular place. That's just what happened. Now, let me go ahead. Let me not bore you with many things at the beginning. Now, what is mitigation block now? A mitigation block is a price zone where the market revisit a previous order block to resolve imbalance. Now we have what we call market imbalance. That's under market structure. We have market imbalance. We have market efficiency and market inefficiency. Now, this is actually the balance and the imbalance. Now, such as unfilled orders or trap retail position before continuing or reversing, unlike the standard order block, which marks strong buying and selling zone before an impulse move. That mitigation block forms when price fails to break a previous high or low, indicating a potential change in direction. Now, look at it. What I mean. Now, we have an order block here. Let me draw it. You see, at this place, we have an order block here. We have another block. Trying to get the drawing correctly. Yes, just leave it at this place. Now look at this place. This is where we got our other block at this particular place. So when price now comes down here and revisits this particular other block side location, the horizontal location here, and begin to move down, is actually what we call the mitigation block. You see this other block, forming some kind of supported resistance. That's confirmed resistance. Now look at this. You discover that here we don't have a mitigation block here. We don't have a mitigation block here. We don't have a mitigation, but we have an order block here. We have an order block, but we don't have a mitigation block. Now look at it at this particular place. Now we could, no, it has not even reached. Okay, it is at this particular extent that we could have a mitigation block that support this particular side here, that support this particular side. Okay, you see, even other, it was not even mitigation block here, because it broke. There was a stop hunt. So now you discover that um not all places or site where price make a lower low or higher high that becomes a mitigation block. Not all side becomes a mitigation block. So let's move on. Why do we now study mitigation block in forex? What do it matter to us? Now, in this 7.5 trillion dollars market daily, which is the forex market, institutions dominate price action because they're the ones that actually move the price. Now, mitigation block reveals where these players or these guys adjust position, creating high probability trade setup. They are especially useful in high liquidity pairs such as our Euro USD, like I told us, USD JPY, all those liquid pairs, USD card, and Euro JPY, and many of them. Now, where institutions activities is pronounced, less reliable in low liquidity or exotic pairs like USD, TRY, US, all those USD, MXN, etc., etc., because of their spread, their widespread, So now let's look at types of mitigation block. Now we have the bullish mitigation block, which we also have the bearish mitigation block. The bullish mitigation block and the bearish mitigation block. Now, the bullish mitigation block form at the end of the downtrend when price fails to make a new lower low, creating a higher low. It acts as a demand zone, often signaling a bullish reversal. The same with the bearish mitigation block forms at the end of an uptrend when price fails to make a new higher high, creating a lower high. It acts as a supply zone, signaling a bearish reversal. Now, let's quickly look at what happened. Yes. Now, this particular, um, this particular, this particular one here is our bearish mitigation block. Look at it. is our bearish, because after this we saw the price selling, is our bearish mitigation block. Now look at this one here. This particular one here is our bullish mitigation block. It's our bullish mitigation block. And look at the ones here. This particular place is our bearish mitigation block. See, price what? Price fell from this particular place after making so many highs, There was what? There was refilling of the imbalance, and after the refilling of the imbalance, we saw that price had to what? Had to drop. Price had to drop. So now look at this particular place too. We have what? We have a beautiful setup. We have a beautiful setup here. Very beautiful setup here. And you see institutional what move. You see it, institutional move. Look at it, guys. Institutional move. These are institutional move. You see, once you are able to locate, and this is news. Once you're able to locate this mitigation block and enter your trade, though it is showing little candlestick and some kind of range market, once the institution put in the money, you discover that you are in the direction of the smart money. You are in the direction of the smart money, and that is a bullish mitigation block. Yes, look at this mitigation block here. Very good. Look at this mitigation block. Look at what has been happening. Look at what has been happening here. Look at it. Look at it. Look at what happened, and then look at the gap here. So price had to what? Had to fill up the gap and then begin to move. Now that is for the bearish mitigation block. Now, guys, let's move ahead. How to spot them? How to spot this mitigation block? Like I've been doing now, is on higher time frames. You need higher time frames and then look at pairs. Now, a trend, you need to look at the trend, the uptrend, and with the higher highs and the lower lows, and a failure to continue the trend, you look out for a lower high in an upward trend. Then the third one is the zone between the fall of the higher low and the previous swing point is the mitigation word block. Is a mitigation block. So you can draw your rectangle around this kind of area like I've shown. You can draw your rectangle around this kind of area so that you will know that this particular place is your what? Is your mitigation blocks. Is your mitigation block. Now if you are to the strategy here, let me show you the strategy here. Now the strategy here says that for example, we have this. Now for you to sell, you have to wait for when price break this box completely. Price must break the block completely. Price must break this block completely. So your entry point should be around this side or around this side. Then you ride with the market, because you need to confirm before entering. There is no trade that you should enter without confirmation. Like I used to say, there is no trade you should enter without the confirmation. Make sure you confirm the trade before you enter. Now, this is how you enter the trade. You have to identify the order block on higher time frames, 4 hours, 1 hour time frame, and after that you check for a retest, which it has retested. You see there was many retests at this particular point. There was many retests. You see retest here, retest here, retest here, retest here, retest here. Price retesting the previous word. Previous, this is a previous block, this is a previous box. Price retesting it. Now after a retest, you look down for entry at a lower time frame. You look for an entry at the lower time frame, and then after looking for enter the lower time frame, please make sure you use good money management. Make sure you use good money management. Your reward ratio should be 1 to ratio 2. Don't go for 1 to ratio 3. Now, which means that when you start at this particular place or just after here, you should be aiming at your first area of profit here and then your second area of profit here. Now, this can be third area of profit, but it's very risky. Look at it. After the third area, immediately we saw an institutional world reversal. So guys, always go to 1 to ratio 2 ratio in your profit. Always go for that. Now, the common mistakes that beginners actually do is that they over rely on mitigation block without context. Now they need to check the broader trend to know if it is on a downtrend or an uptrend. That's a bullish or a bearish, using indicators, so you can avoid false signals. You can avoid false signals, because without you avoiding false signals, you won't be able to enter the trade correctly. So you have to avoid false signals by confirming the trend of the market. So let's look at the advanced identification techniques now. Now, the advanced identification technique, the first advanced identification technique that you can use is the market structure context. In the market structure, combining it with our mitigation block. Now, you can combine market structure context with it in order for you to be sure of your trade. Now, the first thing under market structure which I want us to look at is the break of structure. The break of structure. You know, we have different kinds of structure in the forex market. We have different kind of structure. Now, this can be support and resistance. Sorry, it can be support and resistance. It can be a demand supply zone. That it can be a wedge. It can be a peg net. It can be divergence, etc., etc. Now, knowing this will help us to understand how confidential our trade is. Now, break of structure. A mitigation block often forms after a break of structure, where price break a swing high or low, confirming a trend shift. Now, for example, a bearish mitigation block form after price break. Let me go to. Okay, let me show you. Now, this is what we are talking about. Break of structure. Now, look at this. It's actually a structure here. This particular place is actually a structure. Look at it very clear. There is a structure at this particular place, and this particular place, now that is a structure there. Now after that from here downward is actually the break of that structure. See the break of this structure. See it going downward. There is actually a structure here, and here comes the break of the structure to retest. This particular place that retests this particular structure is the break of structure. Now you need to put it at the back of your mind that the retest is what we are talking about. The retest. Now this is actually the structure. So after the break of this particular structure comes the retest of that particular wall structure. Now, sorry, please check this particular place. You see, this is actually a structure that was broken, and here comes the retest, and here we have the word, the mitigation block. Now the mitigation block is just the retest there. Now the retest is actually what validates that the structure has been broken. So now if there is no retest, it will not validate that the structure was actually broken. Now it's going to be like a stop hunt or a false breakout. Now take note of that. Take note of that, because most times the market makers or the institutions usually bring false breakout in order for them to deceive retail trader. Now look at this particular site, that we have. We're having this particular site. This location here is actually a structure, and here comes the break of the structure and a retest in order for us to have our mitigation block. In order for us to have, so this particular place is our mitigation word block, verifying and validating our break of structure. Now put this at your back of your mind, that it is as simple as ABC. Now let's move on. Let's move on quickly so that you understand. Now we have the change of character. We call it chocho, change of what? Of character. Now a stronger reversal signal where a mitigation block marks a complete trend flipped. That means a change of the trend completely. That is what we call the change of character. The change of character. Now there are different ways for you to confirm this change of character. You can use time frame analysis. You can use time frame analysis, that from the higher time frame, daily time frame, 4 hours time frame, come down to 1 hour time frame. You can understand this change of character. And then you can use your moving average also. When there is a cross between the 200 moving average and the 800 moving average, is actually a change of character. You get it? That's a change of character in the market. When there is a crossing between the 200 and the 800 moving average, is a change of character. Now the next factor is our confluence factor. Now what is confluence factor? The alignment of different indicators in order to confirm to us that this particular trade is going to end well. Now we have alignment mitigation block with Fibonacci retracement level. I always talk about this Fibonacci retracement level in my video most times, because many people are leaving this particular important indicator for them to be able to verify a confluence in their trade. Now this Fibonacci retracement level will help you to get the reversal point, which the high tendency of reversal point always come at the level of 50 and at the level of 61.8. Now we also have volume profile, which I've talked about that in the previous videos. You can check the previous videos, you understand. Now we have the time frame analysis, which I just finished talking about, from higher time frame coming down to the lower time frame, from daily time frame, 4 hours time frame, 1 hour time frame, 30 minutes time frame, 15 minutes time frame. Then you enter your trade. Now using the time frame analysis help you to get sniper entry trade, and your trade will be very precise. It will be very precise. Now look, what are the key tools for mitigation blocks? The key tools for mitigation block, the first is the candlestick pattern. Now we need to understand this. I have a video on the candlestick pattern already. You can check the channel for the video candlestick patterns. Now these confirm retest with patterns like the pin bars engulfing candles or the doji at the block. Now when you see all these kind of patterns, they have what we call the reversal kinds of patterns. The reversal kinds of patterns. Now once you see such kind of reversal kinds of patterns, just know that is actually one of the key tool for you to be aware of the mitigation location block there. Now we have the volume profile, we have the footprint chart, etc., etc. And then most importantly, we have our order block. I talk about the order block, which under the order block we have the order word book. Now this shows order clusters at mitigation block, indicating institutional word interest. When there is too much, or there is many orders, that's trade on a specific order block, it shows what we call interest of the institution around that place. Now you see, this order book is talking about institution, people that has placed order at that particular place so that the trade can reverse and take them on profit. Now we have the fair value gaps. Now the gaps in price action often overlap with mitigation block, making marking areas price may fail before reversing or continuation. Now that is as regards that. Now let's move to the intermediate trading strategy of mitigation block: the retest and the reversal. Wait for price to retest a mitigation block with confirmation. That's our confluence. Wait for price toward to retest. You see, wait for price toward to retest. Now this is our mitigation block here. Now price was moving, and then here comes mitigation block, and then there was a break of structure. It came back to retest it at this place, and then it began to move. Always wait. Now this is the knowledge here. Always wait for price to retest before you enter a trade. Look at this place also. Price came down from mitigation block, came retest at this particular level here before starting the move. That is how you can get it, the retest knowledge. Now let's move on to the other thing. Now we have the liquidity sweep. I've talked about the liquidity word sweep before. Now mitigation block often align with liquidity word zone. That's a zone whereby market makers or institutions are interested in. Now where you can see equal high and low, and then the trade often reverse at that particular place. So what we mean by the sweep is to clear up liquidity. There is high tendency whereby price will move a longer way in the liquidity section, and then we have the confluence trade, using our moving average, using the concept of the smart money concept, and then etc. for also. Now what are the tips there? You have to backtest this with at least 50 trade using historical chart before you can start trading, and then focus on liquidity season, such as the New York and the London section, because they are liquidity season. That's where many institutions are trading. Avoid news event, NFT, etc. Avoid it. So you need to trade in high liquidity season, and then avoid news. Then focus on liquidity pairs like Euro USD, GBP USD, USD JPY, USD CAD, etc. Now for the advanced section of this training, the mitigation versus the breaker blocks. Now mitigation block forms when price fail to break a high or a low, marking a reversal zone without a liquidity sweep. Now the breaker block forms after liquidity sweep where price break a high or low, retest the broken level, and continue in the new trend. Now this is the difference there. There is what? A new trend. While the mitigation block, there is a reversal, while the breaker block is actually a new trend entirely. It breaks it and move on with a new trend. Put it at the back of your mind. Okay, look at the example here. Breakers block and mitigation block. Now this particular place here is mitigation block. Let me look out for the breakout block. Okay, yes, something like this was once a mitigation block before. After going up, it what came down and break it and continue moving. See it continue moving until now. So this is actually a clear word breakout block. See it break, reach here, continue. Now this is a breakout. Now a breakout means that it breaks that area. It breaks, either it is an area of support or resistance, other block or something. It breaks it. While that of mitigation does not break, it reverse. It bounce back and what? And reverse. You see, these things are what gives us advantage over the market. When we have the knowledge that there is possibility for trade to become a mitigation block or a breakers block. Breakers block break the block, while the mitigation, now you have to watch it and be sure. Why? Because there is what we call the institutional manipulation, which is the last thing here. Institutional why? Because they always try to manipulate the trade in favor of them so that they can make money. That's the banks, the hedge fund, and so on and so forth. Now mitigation block are where institutions fix imbalances, that's on field orders from prior move. They may induce traders into traps by by pushing price into the block before reversing. Now their mind is forward for mitigation block, but it will look as if it is a breakers block. You get it? That is what we call stop hunt in the forex market. Stop hunt. They give a stop hunt, and then before you know it, they reverse it back, and then retail traders are being stuck in the market, and definitely you will lose. So you need to have, that is why this particular one is the advanced concept of the mitigation block. You need to put this at the back of your mind, that though you are working with the institution orders and idea, there are times that there is manipulation in the market. So you need to watch out for manipulation, and that this is why we need confluences. You need 1 or 2, 3 different confirmations in your trade before you enter the trade. Thank you so much for watching this training. I will see you in the next training. Don't forget to share this video, download the video, watch it over and over again. If you have any question, drop it at the comment section and I'll be right there to answer your question. Thank you so much. Don't forget to subscribe to this channel and also click the notification bell. Have a great day ahead of you.